With me again today is Brent Wilsey, the president of Wilsey Asset Management. Tech stocks always get a lot of attention, but is that really what you should be invested in, Brent?
Well, that is true, they are. And everybody wants to go to the party or go to dinner and say, yes, I have my portfolio, I have Apple and I have Amazon, and oh, I'm a smart investor and so forth. Yeah. But sometimes people's emotions get in the way. And what happens is that they don't think about what's going to happen over the next 5 years. And if you've been in Apple or Amazon in the last 10, 15, 20 years, congratulations, you've done very well. But your emotions can get in the way of actually what's doing right for the next 5 years.
So the emotions are the problem. Everybody gets all hyped up on the hot tech stocks, right?
Yep, emotions are the problem because there's a thing called recency bias, where it's like, oh, it did well here, so it'll do well going forward. And there is a thing in the investment world called past performance is no guarantee of future results. Right. And your emotions, they will not look at the right thing to do. They'll actually make you do the wrong thing many times because you feel good. Sometimes investing in the right things doesn't always feel good.
No, you're right. Stay the course, of course. Right. So you've got an example of a couple of hot stocks over the last couple of years?
Yeah,
how do they compare?
There was a study done on a couple of hot stocks, Apple and Amazon. Now, over the last 5 years, Apple is up 114%. Very good return. Amazon, not so good, up about 49%. But there's other companies that did better that you'd probably be surprised by them that did better than these hot tech stocks. And one was Tractor Supply. Now, a tractor company outperformed Apple? Yes, it was up 119%, and it pays a 1.5% dividend. An insurance company, how can an insurance company outperform Apple? Allstate Insurance, up 115% and pays a 2% dividend. And then a company that was really on sale about 5 years ago called Tapestry, and they own Kate Spade and Coach purses. Over that same 5-year period, they're up 545%, and they're paying about a 4 to 5% dividend. So you can't just look at saying, oh, it's a tech stock, it's going to do very well. When it comes to investing, you have to build this portfolio that is filled with good quality businesses that were on sale and did very well going forward.
The problem is everybody gets all enamored by the latest big shiny thing. They hear about it, friends investing in it. So dividends you mentioned, I mean, that's important. So how does that usually stack up with tech stocks? Do you get the dividends you're looking for?
You don't want the dividends because the dividends, like we're talking about Allstate, 2%. Well, over 5 years, that's 10%. And what happens with those dividends, you can take that money, you can put it back into the portfolio, not back into the stock, but in the portfolio, and can use that cash flow to pay you even more on other investments that could do very well going forward. So you want to look at that, and also be aware that companies, they many times increase that dividend every year. We have companies in the portfolio for the last 50 years. Every year increase the dividend. So you may start out with a 4 or 5% return, and after 5 years could be a 5 or 6% return. So you want to look at that and keep in mind when you buy that stock at that price, that dividend's locked in. Right now, Tapestry, you probably get like a 2% dividend. But if you locked it in 5 years ago, you got a 5% dividend locked in. So that is what's so important about the dividends. And actually, their studies show that over the last 50 years, dividends account for a big part of investors' returns. So we're kind of a strange period right now.
So bottom line, bigger picture, you got to look outside of just whatever's the hot thing today, right?
Stay away from the hot stuff. Do investing the proper way is what you want to actually do.
Appreciate it. More information online, smartinvesting2000.com. Preceding portion of Good Business San Diego was sponsored by Wilsey Asset Management, and we will be right back.